Hello, and welcome to another Wyckoff Trading video. I'm Jim O'Brien. This video discusses short-term market uptrends and how they help the Wyckoff student increase their short-term profits. Short-term trends last from a few days to a few weeks. During that period, the Wyckoff trader should expect to see a gain of between 15 and 25%. The trend of the market, or an individual stock, is simply the line of least resistance. When, on a rally, a stock meets oppositions to its rise, it must either be strong enough to overcome the selling resistance or it must inevitably turn down. It is vitally important that Wyckoff students always trade with both the trend of the market and the selected stock that matches their investment objectives. That means that if a trader is considering a long position for a short period of time, he or she would want their market index to be in a short-term uptrend. Then they would select a stock that is either in a short-term uptrend or experiencing ending action, like a spring, that signifies the beginning of a new short-term uptrend. The same is true when trading for intermediate or long-term gains, and they will be discussed in more detail on their own videos. Never, ever trade against the trend. It almost always leads to disaster. A short-term uptrend is established when a stock puts in a higher high that is followed by a reaction to a higher low. Analyzing short-term trends requires a good understanding of support and resistance points as the stock either advances or declines.
Texas Instruments offers a nice example of a short-term uptrend. At the time of this trend, Texas Instruments was in a long-term uptrend that began at the end of the 2008 bear market. After a nice move to the upside, TXN put in a normal corrective reaction that ended at point A. Some demand came into the stock and it rallied quickly to point B. The reaction to point C held in the area of point A. Once again, demand came into the stock as it rallied and tested point B. Notice that TXN moved slightly higher than the earlier high at point B. This is a positive indication. At points A and C, TXN met support at the $25 level. Each time the stock met demand. This is beginning to suggest that the stock is ready for a move to the upside. It also suggested that the corrective reaction was completed and the Texas Instruments would move sideways until it experienced some sort of ending action. The ending action came quickly in the form of a spring at point E. TXN rallied nicely off the spring to and then through the resistance lines drawn from points B and C. An initial position to the upside could have been taken on the spring. The rally to point F was higher than the rally to point D. The reaction to point G was also higher than it was at point E. This allows the drawing of a short-term uptrend channel. The support line is drawn through the spring at point E and support at point G. A parallel supply line is drawn from point F. Notice that the reaction to point G was on relatively wide price spread and volume. However, the stock registered a slightly oversold reading of 40 on the technometer. Despite that, TXN had penetrated the resistance line. This is a cause for concern, and the trade should have been closely watched. Stop orders should have been moved to slightly below point G to ensure profits. This concern was magnified on the poor quality rally to point H. Texas Instruments was unable to reach the new uptrend channel's supply line. That was a danger signal. The next reaction would be extremely important. The expected reaction needed to respect both the resistance lines drawn from point D and the support line of the short-term uptrend channel. If Texas Instruments was unable to do that, positions should be closed. That's what TXN did, but not in the traditional manner. As the stock reacted back toward the channel's support line, price spread increased slightly. This, along with a slight increase in volume, suggested some supply was still present. At this point, TXN needed to rally sharply or positions should be closed. It was also important to note that the stock was in a clearly oversold condition with a technometer reading of 38. When a stock is in a more oversold condition on the technometer than on the last reaction, but holds above that reaction's price, it is a very positive signal. This suggests that despite any supply, Texas Instruments could be ready to rally. That's exactly what happened. The next day, after a gap opening to the downside, strong demand returned and Texas Instruments, even though it weakened both the resistance line and the trend channel support line, rallied nicely on widespread and good volume. Even though it slightly weakened both the resistance, now support line, drawn from point D, and the trend channel support line, both were respected. The overall technometer reading opened the door for new positions to be taken or existing positions added onto. This would happen on the rally back into the trend channel. Texas Instruments continued its rally within the short-term trend channel until it reached point J. Notice that at point J, the stock was unable to reach the trend channel's supply line. This is an early warning that the trend could be in jeopardy. Then, Texas Instruments reacted to point K on moderate price spread and reduced volume. It honored the trend channel supply line. This gave the stock an opportunity to continue its nice rally. That didn't happen. The rally to point L quickly ran into supply. Not only did the stock fail to reach the trend channel support line, it was noticeably further away than it was at point J. This strongly suggests the short-term rally is in trouble and positions should be closed. Although Texas Instruments made one additional attempt to rally, that failed, and a subsequent reaction broke the short-term uptrend channel. Wyckoff traders who took positions on the spring saw a 20% profit in 8 weeks. Profits were increased if additional positions were taken at point I. I deliberately selected a stock that produced a relatively mild gain. Texas Instruments' short-term rally contains several good examples of what the Wyckoff trader can expect when doing short-term trading. Short-term moves are relatively modest, but can result in a nice return in a short period of time. You can learn more about these profit-making strategies by reading our Wyckoff ebook called Wyckoff Strategies and Techniques. As a special bonus, a free audio recording of the ebook is included with every purchase. The audio recording has its own set of charts that make it easy to follow along as you learn more about the Wyckoff strategies and techniques. Learn more about how to make better trades by using the time-proven Wyckoff strategies and techniques by clicking the link below.